Hello, I'm Finola Burke from RaaS, and welcome to our 2023 Outlook series. In this session, we're focusing on US energy producer, Australis Oil and Gas, ASX ticker ATS, I should say. And joining me is Ian Lusted, Managing Director and CEO of Australis Oil and Gas. Welcome, Ian, to our Outlook series.
Good morning, Finola. Thank you for having me.
Now, Australis Oil and Gas holds significant acreage within one of the last appraised but undeveloped oil play regions in the US, known as the Tuscaloosa Marine Shale. Within this region, ATS holds 81,300 acres with a net oil resource 2P and 2C of 153 million barrels. For the uninitiated, Ian, could you please take us through why this is a strategically important region?
Yeah, of course. It's obviously quite a big question, and I'll try and be succinct. You actually caught there a bit of the phrase that we often use when we're talking about this play. We believe it's one of the last high-quality, appraised but undeveloped, unconventional oil plays left actually in the lower 48. And that's a big statement, and I thought it might be worthwhile just picking the eyes out of that and explaining why we make that sort of statement. So the first thing is why is this one of the last ones left? US unconventional, obviously it's turned the world on its head and the global market in the last 12 years. Production's grown by 7 million barrels a day, and that's nearly all come from the unconventional sources. It's well known, it's perhaps less well known, that maybe 85% of that actually comes from just 3 areas or plays: the Permian, the Eagle Ford, and the Bakken. And these plays have been around for a long time. It's not as if we've only just discovered them. The geological conditions allow oil and gas to be generated in what we call these source rocks. They've been identified for decades. It's really been around the application of technology to extract that oil from the source rock. And it's important that I make that distinction simply because it's not around unconventional oil and gas, it's not around exploration now. It's about whether we can commercially develop them using that technology. So whilst there are those 3 plays which are mature and well developed, there's a small handful of plays that are just emerging, but they're reasonably well understood. But it's not as if we're out there looking for new undeveloped plays to be discovered. And as such, we expect to see the TMS to be one of the last now or cap off the ranks. We've mentioned that it's been appraised. The play was first drilled probably back in 2010, and all plays have variability, but the TMS is perhaps a little bit different in that variation is not graduated. It's more binary in nature in terms of reservoir quality. So the early results were therefore quite mixed, where there were some big guys that came in, took a big position, drilled a few wells and had poor results. But amongst that, there was a smattering of good, solid oil productivity. And that led to further appraisal, further exploration within the defined areas. And really, it was in 2012 and 13, the best part of the play was identified. In fact, one company, a company called Encana, they built a large position and they internally declared the play commercial, and they were in the process of ramping up to full development. The oil price crash happened at the end of 2014. That company was over leveraged, as were others in the play, and Chapter 11 and debt restructuring put a stop to all activity. But there were about 50 wells drilled, and they've all got sort of 5 to 9 years worth of production. So we can not only know where the area we need to focus is because of the work that's gone previously, but we can also compare that production performance to the much more established plays. They've had tens of thousands of wells drilled into them. And I can say that from a rock deliverability, from a reservoir quality, it's as good as any other play in the US. Now, location, typically these plays are limited in terms of access to infrastructure and distance to market, etc. That's not the case for us. We're in Southwest Mississippi. We're only about 60 miles away from some of the major Louisiana refineries that are out there. And our acreage is literally crisscrossed in pipeline infrastructure. So those normal factors are just not relevant for the TMS. So we've got all the ingredients that we're looking for in terms of a potential opportunity. And to answer why it's a strategic asset, I think it's important to understand that whilst these are very large and have big in-place volumes, they are finite. And in particular, those better parts of the plays have a limited number of drilling locations. And those 3 established plays that account for most of the production are now becoming increasingly mature. It means that whereas participants in the industry would typically have looked in their own backyard for additional opportunities, they're now having to look outside of that particular sandpit. And for plays like the TMS that has some track record, then obviously that's encouraging. Our business strategy is to build a big position, bring in a partner to help fund some of that initial activity. And obviously that's encouraging for us as well. So we think we tick all the boxes, and we think that it is a fairly unique asset, and increasingly so in the US, and ultimately that will translate to value.
You may have touched on a little bit of this, Ian, but under the transition to new energy, there has been a tangible change to the onshore industry in the US, with the big companies exiting or divesting. Have you seen a stronger concentration towards the known provinces and away from more frontier plays? And is the pricing for leases changing materially as a result?
Yeah, that's a good question. I mean, the US I think, is a little bit different, say, for instance, to Europe and the way it's reacted to the transition that's occurring. The big companies, the Exxons and the Chevrons and so on, probably have a very similar sort of business message that they're doing as their European counterparts. But the bulk of the drilling in the US and activity in the US is actually done by the large and mid-cap independents. So these are companies from sort of $5 to $75 billion market caps. And they've very much stayed focused on core business, albeit with an increased sort of commentary around some of the environmental metrics on oil and gas exploration. So we're seeing activity levels still stay strong, but for some of the reasons I was just outlining in terms of inventory depletion, we're now starting to see, certainly in the unconventional space, branching out and looking at some of the other plays that are out there. And that's we've seen an increase in inbound interest in terms of what we're doing as a result of that.
And how is the services business trending on costs and availability, particularly as that market looks like it's going through a weaker oil price period at the moment?
Yeah, look, if I stretch it out a little further, we've been affected by the same supply chain issues and broad inflationary costs that the rest of the world is seeing, without doubt. Perhaps because the industry has had a more measured response over the course of the last few months, it might be slightly tempered, but we have seen service costs increase. We're probably 25 to 30% up in the last 18 months, and that's meaningful and a challenge, particularly for a smaller company like us. The recent weakening we've seen in the last 2 to 3 months, we are likely to see that transition through. It typically takes us maybe 6 months before we see that appear on service costs. But in the timeframes we're thinking about at the moment in terms of restarting activity, we may see the benefit of some of that.
Now, we've also seen the Australian government has begun to impose gas price controls in a signal of a more adventurous policy. That has an impact on Australis. But what are you seeing from the US government in this regard, if anything?
Look, it is probably limited. Certainly, there are the same political pressures, I think, on governments throughout the world at the moment. The reaction by the US has perhaps been a little bit different. There's been large releases from what they call the SPR, the Strategic Petroleum Reserves. And that's certainly helped keep petrol prices in the US lower, which is a big political issue at the moment. That's a double-edged sword. They are mandated to replenish everything that they've recently taken out. And so they'll be buying in the market now as we go forward into 2023. So that's interesting. But I think it's worth pointing out that from a strategic perspective to the US and its international politics, domestic production is key. And I don't think it matters what political bent the party is in power at any particular time. Maintaining that, I think, is going to be very important. So we've not seen the same level of intervention. It's been a much more subdued and hands-off approach by the US authorities to date.
Well, Ian, thank you for joining me today to discuss the 2023 outlook for Australis Oil and Gas. I'm looking forward to catching up with you through the course of the year to revisit where things are at.
Likewise, look forward to it. Thank you very much, Finola.